Thanks for joining us today. You have got Alyssa here. I am a lead advisor with Hendershott Wealth Management, and I am here with Hollina, who is also a lead advisor with Hendershott Wealth. Nice to have you here today, Hollina.
We've got a lot of fun things to cover. I'm excited to dive in.
Yeah, for sure. And we're talking about the exciting topic of income taxes today, which is just a lot of fun for most people.
I would say probably more fun for us than it is for the average person, Alyssa.
It's like a puzzle we like to solve sometimes. So, as a little bit of background, we are going to talk about the One Big Beautiful Bill Act, the new tax law that passed in July of 2025. It is something that we've talked about as a team and with our clients even before it passed. Earlier in 2025, when Trump first took office, there was a lot of things being floated around. People were thinking, should I make changes right now? Should I change how I draw my income or how I do my estate planning? We really wanted to encourage our clients and listeners, wait until it's tax law so that when you make changes, you know what you're making changes based upon. It's not based upon campaign promises or headlines that might not come to fruition.
Yeah,
And what do you
absolutely.
remember some of those headlines, Melina?
Yeah, for sure. There was some around no taxes on tips. Is the federal estate tax exemption going to go back to the old amount or not? And we'll give some examples on that today. There were just a lot of things in the headlines and people coming out saying, should I make changes or what's this going to mean for me? There's good reason why we say let's wait until things actually come into law. These are
Mhm.
all proposals, right? They are
Yeah.
proposals, they're ideas that are thrown out there, not things necessarily going to happen.
Now may be the time for some to take action, and we'll talk about some changes and the background of the OBBBA Act and how it may affect you.
Many of you may know this, but this was a 900-page document. So there was a lot in there. Some of it's really relevant to our clients and helpful, and some of not as much. We really just got to figure out what specifically applies to you.
In this podcast, we're going to go page by page, right? We'll just read all 900 pages out loud and then talk about it, right?
And 12 hours later, here we are.
Right? Yeah. So obviously, we're not going to go over everything in this podcast. We've picked a few items that we think are most relevant. It's not a complete list of items. It's some of the things that have changed more and that might be relevant to households that are listening.
Let's talk, Alyssa, first, maybe about some of the things that are staying the same.
To address that, I think maybe we have to go back as far as 2017, because when Trump was first in office, he passed the Tax Cuts and Jobs Act, which is TCJA, a lot of people call it. And in that Tax Cuts and Jobs Act, he changed how we use the standard deduction versus the itemized deduction. And those are terms that not everybody knows, but we all still track our deductions. So things, common deductions that we see are like state and local taxes, mortgage interest, charitable contributions, medical or dental expenses that exceed 7.5% of your income. So your tax preparer behind the scenes is adding all those things up and coming up with your list of deductions. And they compare that to what's called the standard deduction. If one is bigger than the other, you get the larger of the two as a deduction off of your income. Before the Tax Cuts and Jobs Act in 2017, the standard deduction was about half of what it is today. When that doubled, most people started using the standard deduction. People actually stopped itemizing a lot of those things I mentioned. In 2024, about 90% of households use that standard deduction. That was a big change that Trump made in 2017. It was going to sunset at the end of 2026. There was some question around, are the tax brackets going to remain the same? Is the standard deduction going to change by a lot? He extended a lot of those things. So he left a lot of the things from the Tax Cuts and Jobs Act similar to what it was with the cost of living adjustments, little bumps each year. We're going to talk about the standard deduction a bit today. We're going to talk today about what is a phase out. Hollina, do you want to describe what a phase out is?
Yeah, it's becoming more and more common to have phase outs for everything. What that means is that you can get the benefit or qualify for something based on your income. If you get above that income, you phase out of being eligible to do that. For example, contributing to a Roth IRA or a traditional IRA, there's income phase outs, meaning if you make too much money, and we're not going to go into all the numbers today on that because there's a lot of numbers around. Once you reach this income amount for single or married filing jointly, you no longer are eligible to contribute to an IRA or a Roth IRA. So a lot of these things that were implemented into the OBBBA, we're going to probably call that a different name each time or say it differently, but there's phase outs for when you're eligible for some of these items. So it's important to be mindful of that.
Are phase outs cliffs? I mean, does it like you make $1 more than that and you lose the deduction? Most of them are more gradual.
They are
Right?
gradual. So there'll be a range. Like if you fall in the middle, you can partially get this perk or benefit or partially contribute to a Roth or an IRA. It's not like now I'm $1 above, I can't do any. They have these ranges. But once you're at the high end, then you're just completely excluded.
Right. So like a phase out of 150 to 250,000 of income, you get part of it if you make between the 150 and the 250. And once you hit the 250 number, it's zero for that deduction or that IRA contribution or whatever the phase out is referring to.
Yep, absolutely.
MAGI. I had to Google how to say it. The internet says you're supposed to say MAGI. That's your modified adjusted gross income, which is not listed on your tax return. So how would I know what my modified adjusted gross income is?
It's a mixture of things, right? You're taking your adjusted gross income and removing some of the items that we may be deducting out of it. If you just said to somebody, what's your modified adjusted gross income? They probably don't know it. It's going to be important to work with your tax preparer on figuring out what that number is for you and what items are being removed from your total income and adjusted gross income to get to that number because it's not clear because it's not listed in the tax return.
And so, since we're talking about consulting with professionals, my lawyers need us to remind you that this information on this podcast is for general education. Details or qualifications may apply to these provisions that may be necessary to apply to your tax returns. What we're talking about today is not actionable tax or financial advice. It's general education. We reserve our personalized recommendations to our clients with one-on-one conversations where we can tailor our guidance, apply what we know, and give it to them based on their unique needs. So that is my disclosures for today. So, Hollina, we were talking about how a lot of things in OBBBA stayed the same, didn't change from the Tax Cuts and Jobs Act from 2017. Can you talk about a couple of those things?
Yeah, I'll talk about some of the federal things that stayed the same since being changed in 2017. One of them was federal tax brackets. Are these going to change or sunset at the end of 2025, beginning of 2026? So, compared to what the pre Tax Cuts Job Act said, most brackets were lower and those remain the same, right? The highest federal rate fell from 39.6% to what's now 37%. So that's staying the same. That's not going back up to that higher amount. Federally, in 2017, the federal estate tax exemption doubled. So you could give away many millions. That's gone up every year with inflation adjustments. Now you could give away $12 million plus. This year, it's $15 million per person, $30 million for a couple. But basically, it was stating that, that if that sunsets back to the original amount, then you were only allowed to give away about $6 or $7 million per person, and it be excluded from federal estate tax. And each state has their own different law for state estate taxes, but the federal amount actually stayed the same. So in 2026, it's $15 million per person. And that's the total amount you can transfer during your life or at death before you would then trigger federal estate taxes. Do you have a question on that, Alyssa?
Yeah, so a parent who gives securities, a house, or money to a child during their life or at death. I hear a lot about gift tax, and so parents are able to gift to their children or other recipients this amount up to 15 million before any type of gift or estate tax comes into play, right?
Correct.
Sometimes we still have to fill out a tax form when we give small gifts, but there's no actual tax on that. The tax form is just tracking that number, right? Up to the $15 million number.
It's one of the most misunderstood concepts with gift tax because the federal annual amount is this year $19,000 per person. And
Mhm.
so people are like, I can't give away $50,000 to my child because I'll have to pay taxes. I can only give them $19,000. Well, that's not
Yep.
true. It's just any amount over 19,000 that you do give, you would have to file a gift tax return. And then it would say, here's $15 million that you can give before triggering taxes. Take away the additional $31,000 that you gave because 19,000 is excluded. And now you can give away 14 million X dollars, right? So there's no gift taxes. It's just, it goes against that total 15 million that you can give. I can't tell you how many times Alyssa and I, our whole team, we see it all the time. It's like, no, I can't help. I can't give them $100,000 to buy a house because they'll pay taxes. They'll have to pay taxes. It's important to look at state laws too.
What we're talking about today is all federal. Everything we're talking about today is federal. That's a good point about the estate tax because a lot of people were thinking if the estate tax is going to go back down to the $6 or $7 million number before taxes are triggered, should we give away wealth now? Should we redo our estate plans based on this item that could sunset?
Oh, yeah. Oh my gosh. We had so many people that, because if your net worth was higher than that, those clients that net worth is more than $30 million, it was like to take advantage of this free money to give away, right? They could put it in an irrevocable trust where you can't change your mind when you do that. Or they were saying, okay, now we're going to gift to our children several $1 million so we can take
Yeah.
advantage of it, or just gifting in general to anyone. And we kept saying, well, we don't want to make these choices until we know that this is actually going to sunset back down to
Yeah.
potentially half the amount. That's just one example of saying we really got to wait until it becomes law before we make decisions. Many things were proposed, ideas were thrown out, but how many actually came to fruition or were in the actual law, that's what matters most. The planning comes into play once these things happen.
OBBBA has the lower tax brackets, higher standard deduction. So more of your income is preserved from taxation from the outset. When you pass away, there's a huge estate tax exemption. So more is protected when you pass away or gift. All those things mean less tax. What came from the Tax Cuts and Jobs Act and really got extended with OBBBA. So
Yeah.
that's kind of nice.
You want to talk a little bit though about the qualified business income?
I do. I really like the qualified business income. It's a nice deduction for people refer to it as QBI. It is a deduction for people who have self-employed income. So that might be sole proprietor or S corp. Most of it comes in on like a 1099 or a K1, but this kind of self-employed income is now eligible starting with the Tax Cuts and Jobs Act in 2017 for a 20% deduction. So for example, if you had S corp profit of $100,000, only 80,000 of it was taxable. It's a nice benefit, and there's a lot of planning opportunities for our clients who have businesses to look at their different deductions and income sources in a way to optimize QBI. QBI ends up being a big benefit if you only need to pay tax on 80% of your income, right? You get 20% on the outset without being taxed on it. So for the most part, QBI stayed the same, little cost of living adjustments and phase outs, thresholds, but for the most part, it stays a generous tax deduction for business owners or people with self-employed income, partnerships, sole proprietors, S corps.
So that was some of the things that stayed the same. Of course, like we mentioned, we're not going to go through 100 pages, but I do want to shift gears a bit and talk about what some of the changes were and some of the ones that are probably going to affect more people that we work with. Let's start by talking about a few of those. One of the most talked about ones that I'm hearing a lot about is that SALT cap. Do you want to go ahead and explain that one,
For
Alyssa?
sure. Yeah. So earlier I talked about when you itemize your deductions versus the standard deduction, whichever's bigger you get to take. And SALT is one of the biggest itemized deductions.
What's
SALT
it called?
stands,
Okay.
it's not a salt shaker, it's state and local taxes. For most people, it's their state income taxes that they pay, but property taxes are a big one in there for homeowners. The SALT cap with the Tax Cuts and Jobs Act in 2017 was limited to $10,000 deduction. This meant for people who lived in high tax, income tax, and property tax states, those two items together couldn't exceed a $10,000 deduction. Well, a lot of people pay more than $10,000 alone in property taxes in states like California, New York, where property values are high, so property taxes are high. And then usually in those same states, income taxes are high. Speaking from California, as I sit in California, income taxes are high and property taxes are high. So most of our clients who live in California, their SALT adds up to much more than $10,000, and it was capped at that. That cap has been increased to $40,000. There are phase outs. So being able to deduct $40,000 of state and local taxes is going to benefit a lot of taxpayers in high income property tax states. The OBBBA Act specifically raises it only for tax years 2025 through 2029. So another sunset is going to happen in 2029. And this planning is really only going to affect those tax years, 2025 through 2029. The modified adjusted gross income starts at $500,000 and goes up to $600,000. If you are in that range where your modified adjusted gross income is $500,000 to $600,000, you're going to see that $40,000 drop back down to $10,000. You definitely get the benefit of the $10,000 deduction, could get more of a benefit up to $40,000, but then that phase out happens. And so if you make over $600,000 as a married couple filing joint, it's dropping off to back down to $10,000. So the nice thing is that everyone benefits from the new SALT rules. You'll either get the same $10,000 or up to a $40,000 deduction. That phase out happens between $500,000 and $600,000. If you make over $600,000, your benefit is $10,000 deduction on SALT. So there's some planning opportunities there. If you're close to that $500,000 to $600,000 phase out, there's some planning opportunities that could happen with your tax preparer or financial advisor to keep your income below that phase out. Losing a $30,000 deduction is a big one. Yeah. It's a big one if you're a homeowner.
Well, with that, I think we should probably keep talking about deductions because there's also one in there about seniors and a deduction they get.
On the campaign trail, Trump talked about no taxes on Social Security, right? And that is not exactly what got into OBBBA, but what did get in is a senior deduction, which is a deduction for anyone age 65 and older. You don't have to be drawing on Social Security. You don't need to meet any other requirements. If you're 65 or older, you get a $6,000 tax deduction. So for couples, that's $12,000, which I've heard limits about 90% of taxpayers to not paying tax on Social Security. So it's not exactly no taxes on Social Security, but in practice, it's going to mean a lot of people don't pay tax on their Social Security income. Of course, it's not that easy because there's a phase out. And that phase out is $75,000 per tax filer. If you're filing jointly, it's $150,000 starts the phase out. And then the phase out runs to the $250,000 number. So if you're married filing joint, it's $150,000 to $250,000. $12,000 tax deduction is a great benefit. We've had a lot of conversations with our clients because we often look at Roth conversions as a planning tool to avoid taxation in the future, especially taking advantage of some of these lower tax brackets that we're seeing. With this new senior deduction, we really want to keep in mind that $150,000 to $250,000 phase out. Because if you run a Roth conversion and it increases your income and you break the $250,000, well, now your client has lost a $12,000 deduction or added a 12% penalty by running that Roth conversion and breaking that phase out. So those are some of the planning tools that we keep in mind with our clients, and we make sure to keep in mind when we're looking at things that would increase income.
So remember when we mentioned these phase outs, we're talking about a phase out with almost every item here. It's important to be mindful of that because if there's strategies we can implement and work with your tax preparer on, it's important because it's amazing what things could impact your overall situation. I know I've heard some folks over 65 being excited about this extra deduction, but making sure that you're still eligible for it. If you are over that income, you're not. I'll jump in here on the child tax credit because it also has a phase out. If you have children that are 16 and younger, the tax credit for each child increases from $2,000 to $2,200 per child. This is actually a credit, and a credit reduces your tax bill dollar for dollar. This has a phase out starting at $200,000 of modified adjusted gross income for single filers, and then $400,000 for joint files to be eligible for this tax credit. So that's another one that was a change, and it's not huge, right? It went from $2,000 to $2,200, but it's something.
The credit is more valuable than a deduction in most cases because it reduces that tax bill dollar for dollar. Another new thing that came in the OBBBA Act is an auto loan interest deduction. This is interesting because the EV tax credit is going away for most electric vehicles and some of the plug-in hybrids. There was a federal tax credit, and that's going away this year. What's been put in its place is this auto loan interest deduction. If you purchase a new vehicle, the final assembly has to happen in the United States. The vehicle must be brand new, and you could deduct up to $10,000 of interest paid for that vehicle only in tax years 2025 through 2028. So it's another one of those that's for a short time, and it's going to have a sunset. This one has a phase out starting at $100,000 of modified adjusted gross income for single filers and $200,000 for joint filers. But not bad if you are looking at buying a new car. You can get some deduction on that interest.
Do you want to talk a little bit about the tips and overtime deduction?
It was touted as no tax on tips and overtime, and it became an above the line deduction for certain tips and the overtime pay premium. If you're in an industry that you customarily and regularly get tipped, which is the IRS language for those who are eligible for this deduction, you could receive a deduction for about $25,000 of your income. Of course, you have to report the income. So you have to report the tips and then you can deduct the tips. They don't have to be in cash or credit card. It can be any kind of tips. When it comes to overtime, it is only the overtime pay premium. Most employers pay time and a half for overtime. It's the extra half that you get in time and a half pay. You could deduct that and not pay taxes on it. There's a phase out for all of these, and that phase out is $150,000 for single filers of modified adjusted gross income or $300,000 for joint filers. That's where the phase out starts. It can be beneficial to a lot of food service workers, a lot of people who are regularly tipped, get a new deduction there.
As the Social Security and the tips one were talked about, there's pieces to what those proposals were. The headlines read, but not as big as what a lot of people were expecting or hoping for. Okay, well, just a couple more items that we kind of want to highlight. One of them is 529 plans. Those are education plans. You can fund those, grandparents fund them, or parents, or just other family members that might want to contribute. But beginning January 1st of 2026, the total limit for all the K through 12 expenses is going to increase from $10,000 to $20,000. So you can, and maybe some people don't even realize this, but 529 plans aren't just for college. They can be used for tuition, private schools, and K through 12. Now that annual limit is rising to $20,000.
Hollina, this is one area where the states don't align with the federal government. Some states don't allow that same deduction. So you really need to loop in your tax preparer for your specific state. Am I going to end up paying state taxes on this, whereas I can not pay federal?
Yeah, because of course it's nice not to have to pay the federal, but you may be surprised if you're like, oh, wow, now my state is requiring me to pay taxes on So yes, you're right. Federally, we have to keep this in mind. This is a federal act, not for each individual state, which is also why it's so important to have a good tax preparer and somebody that you can work with. We work very closely with our clients' tax preparers.
Yeah.
So with the 529s, another expansion was the definition of qualified education expenses for K through 12. It's not only tuition, you can also cover things like books, testing fees, materials, educational therapies, tutoring costs. So it really expanded what you can use it for. Of course, the
Wow.
benefit being the tax benefit, right? Because some states have a tax benefit for contributing to 529s, but federally, it's not like you get a deduction for contributing. It's more so that you're now having this invested and growing tax deferred, because if you use it for qualified education expenses, then you're able to pull these funds out tax free. So that's the perk there, right? If it's invested, now it's growing, and that growth will be tax free if you're using it for qualified expenses.
Yep.
So another expansion then is like what 529 funds can pay for. I can't tell you how many times we have the conversation around what if my child doesn't go to college, or what if they want to go to a trade school? What does 529s cover? So now they've expanded that. They'll pay for credential programs. For example, Alyssa and I are certified financial planners. And it now would cover that program if your child wanted to become a CFP. Professional licenses, certificates, including like registered apprenticeships, continuing education courses, and fields like auto repair or food safety. So
Yeah.
it really expanded what these funds can be used for.
Right. What a great advantage. And you're right. That is a very common question from clients. Your son Paxton is so young. How would you know if he's going to go to college?
As a parent, you may say, of course, I want them to, but who knows what college is going to look like? And again, it's like, what if he wants to become an electrician or do something different? It's like people say, I don't want to overfund a 529, but that's a whole nother thing. Like there's lots of different options you can do with 529 plans now that have been expanded as well. So, but
For another episode, right?
right. Yes. Yes. Okay. So anything else on 529s, Melissa?
No, that was really great. I enjoyed hearing about the different licensing programs, and I didn't know about the educational therapy and tutoring costs. There's so much in that 900-page bill. We're still learning, and that's a great one.
I think maybe the last one I'll mention is charitable deductions. The OBBBA does have some new above the line options for those who don't itemize. And
Nice.
and then of course there's like a very small floor, or like I don't know really how to explain floor very well, I guess, Alyssa, but basically if you do itemize, right? In the past, clients will say, oh, I gave $500 to charity, that's deductible. And it's like, well, not necessarily. If you itemize, it's deductible. But in order for the charitable deduction to actually show as a benefit on your tax return, you basically had to give more than if you were taking the standard deduction, you'd have to give above what the standard deduction is. And I don't think a lot
Yeah.
of people realize
Well,
that.
it changed in 2017 with the standard deduction. So it was pretty cut and dry before. If you gave a charitable contribution, you got a tax deduction, but it's not so cut and dry anymore. There's been a lot of changes to charitable deductions. So I think this one gave a small benefit to most taxpayers. And you'd really want to track your charitable donations and consult with your tax preparer to see what kind of benefit you get. There's a couple different ones that have come, whether you're itemizing or not itemizing now, there's a little benefit.
For those who are not itemizing, if you're taking the standard deduction, you can now, this doesn't start until 2026, but you can deduct up to $1,000 for single filers or $2,000 for married filing joint in cash contributions to public charities. You can say, okay, I gave $1,000 and I take the standard deduction. So track that, because that can benefit your tax return. But be mindful, if you gave to a donor advised fund or a private foundation, those aren't eligible items, making sure that it's cash contributions to public charities. Tracking that is going to be important going forward. Those who said, I gave $500, it should matter. Well, it does matter because that was the kindness of your heart and charity, but also now it matters on your tax return. There's going to be some benefits to charitable deductions going forward.
And as you talk about all the nuances, I'm just reminded of how important it is to have a team of advisors, a tax preparer who is proficient in the new changes that happened, passed on July 4th, 2025, this OBBBA Act, and how important it is to consult with people who know how this could be applied to your situation.
Anything else you want to talk about, Alyssa?
I think we covered a lot. And I think as we wrap up, listeners are going to be asking themselves, what does this mean to me?
Yeah, for us, it's really important to just say it depends, right? Because no one likes that answer, right? It depends. But it really, so we always tell our clients each person, each couple is their own puzzle. And how this applies to you really depends on your situation. We work closely with our clients to make sure we're, of course, staying up to date with these changes and how they may impact you when we're doing things like Alyssa mentioned with Roth conversions. We're paying attention to that, how it may impact your deductions, your Medicare, things like that. We will be sure to always make sure to implement the details and talk through them with clients, but all of them don't apply to you, right? Some of them do though, and it's going to be important that you work with your team of experts, and that means talking with your team of advisors, right? So your financial advisor, your CPA, tax preparer, tax advisor, and your estate planning attorney. That's your team of experts to make sure things are being implemented in your best interest. That's why we work really closely with attorneys and CPAs too, is because we want to make sure we're all on the same page for our clients.
Yeah. At the end of the day, tax law provides the framework, but the meaningful results come from personalized planning, thoughtful, personalized planning. That's why our team works with our clients to understand not only their cash flow needs, but their charitable inclinations, what kind of businesses they have, the structure of that business, what are their estate planning goals, what are their values, what do they hold dear to their heart. And we're already modeling for our clients how OBBBA fits into their financial picture. If you, as a listener, would like that kind of personalized planning from a financial advisor, we encourage you to reach out.
So all this being said, we would be more than happy to walk through what this law means for you based on your current financial picture, along with specific numbers-driven recommendations for the future. Of course, you can visit hendershottwealth.com/contact to book a complimentary 45-minute Discover call with one of our lead advisors.
You may talk to Hollina even. We're excited to hear from you and see how this OBBBA Act, OBBBA rules changes fit into your financial picture. Thanks for tuning in to Love Your Money. We're excited to break down this 900-page bill for you and to hear from you. Thanks for listening.